Welcome to the Smart Property Investment Show, the podcast by investors for investors.
G'day, Phil Tarrant, host of the Smart Property Investment Show. Finally, we're here, our special series for the Fast 50 2026, where to put your money today for the best capital growth in 2026. This report, which is highly anticipated by people right across the nation and also parked in places all around the world, knowing where to put their dough in resi real estate in Australia. For many of you, this is the report which may guide you on your investment journey. It may also be the catalyst to get you starting in investing and where you might start with assessing and realising the opportunities that you can focus on in your wealth creation journey through property. I enjoy this as a 6-part special series. You're going to see it all in one block wherever you watch this, whichever streaming service on the video, or whether it's across the podcast channels, Apple, Spotify, etc. 6 special parts where we pull apart the Fast 50 for 2026. We give you insights, some colour, some narrative, probably some complaints, no doubt, from me on these suburbs to help you on your way. It's pretty exciting stuff. The 3rd year in a row we've done this. Joining us back again, the first inaugural and continued partner of the Fast 50 report, Paul Glossop from Pure Property Investment. You may know him. He knows himself. I'm going to leave you alone. I'm going to try and be serious and professional on this podcast series, Paul, which I know may come as a shock to you.
Well, it's been going for 1 minute and 41 seconds so far, Phil, and you've done probably the best you've ever done with me on the other side of the mic.
Well, this is the feedback. People are saying, Phil,
leave Paul alone.
Leave Paul alone. He's very, very fragile and vulnerable, just like the Australian property market. Yes. Leave him alone. Leave him alone. Like, leave the property markets alone. Don't mess it up. Don't mess up property markets, they say. You guys with your Fast 50 report, we get calls from mayors right across this great nation saying, hey, look, can you get me in this year? I reckon I can get some more GST rebates if I make it in the list and attract some more property. We go, no, we can't be bought.
Get the sales agents in there saying, I'll rev up sales.
We can't be bought.
I reckon a bag full of fresh Chico rolls might sway you one way or the other.
I reckon what we should be doing, and I saw a piece in a paper the other day about some bloke. You ever watch the, is it Sapin on the YouTube? You know, the ex-crim who goes around and goes to all dodgy joints. And he did a takeaway shop review.
Oh.
And as a guy, I think out of Arncliffe, called Chicken George.
I actually
did you see this?
I saw the Chicken George episode.
Yeah, Chicken George.
Wrapped the chips and the vinegar. And he likes it old school Chicken George.
He does. I do like, and I get excited when I see stuff like that. I do like a takeaway shop. So I'd like to think, maybe the next iteration of this is for us to get on the road and visit these Fast 50 suburbs and actually look at them, how you should be assessing whether or not something is a good property investment, or whether a good location.
Maybe we need to double down. Once we release this, maybe you and I, 6 months down the track, we take this same report and we do the same report correlating it with the chipper, the local chipper in each of these suburbs, and rate the chippers.
Yeah.
The Fast 50 chippers.
Well, I think we should go a little bit further, right? I reckon we should be assessing every single suburb. And by the way, as a disclaimer, don't do this.
Chip shops do not
No.
correlate to growth.
I reckon we should be rating every single suburb on, number 1, local pub, number 2, bakery, number 3, Chinese shop, as in restaurant, number 4, chicken shop and or the fish and chip shop, number 5, their drive-through bottle shop.
Okay.
What else?
Which can be one in the same.
Which can be one. Can be one of the same. And I think that would be the appropriate way to measure whether or not a suburb is a good location.
Okay. Measure the ambience, measure the success.
Maybe you can help us out with this.
Maybe even if it's just a little bit more simpler, just looking at the average price of a large chips in each of these suburbs might give you some actual definitive understanding as to the affluence.
I can tell you, mate, and I will be doing this evening. I normally get a takeaway on this particular night of the week. Where I buy my Thai food,
I can only assume
$7.
For what? For
prawn
a bag
crackers.
Of prawn crackers? Yeah. Robbery.
What happened to the world?
What happened to the complimentary prawn cracker?
I don't know, mate. Well, if you go to a great Chinese restaurant, Lee's Fortuna Gardens, which I know a lot of people would probably know about, and what's this got to do with property? Who knows? But you still get complimentary Fortune cookies, and you also get complimentary
Are,
prawn
are they
crackers.
not Fortuna cookies?
No, they could be. They could be. But this is how you assess property markets in Australia, I'm told. Let's
Okay.
get serious.
I'm not sure who'd buy, but anyway.
No, anyway. You started it. You started it. Talk about Chicken George. But where to put your money today for the best capital growth in 2026? This is a real deal serious report, right? And
6
I know
months in the
we had
making.
a bit of fun and, enjoy. We've got 6 episodes to work through, which we've sort of broken down the way we're going to do it. And I think this is probably a good construct. We're just going to give you a bit of insights, a bit of narrative around the report, why we're doing it and how we're doing it, how to use the report most importantly, and also a sense for how we put it together and the myriad experts involved in doing it. And a big shout out to the team at Smart Property Investment who have done all the heavy lifting with this. And the report's now been out for about a week or so, and we decided to, give it some breathing space before we get stuck in to actually record this special series. A couple of reasons why. Number one is that we're waiting for the May interest rate announcement to happen, which did happen, and we all now know that interest rates have been cut by 25 basis points. So already you're no doubt seeing this huge commentary right across the media landscape, from armchair economists, guys like me, to real economists, guys like Shane Oliver and that cohort, pretty much saying it's going to accelerate property prices. So lots to get through there. The time is right. You haven't missed it. What we've unlocked here is going to give you some real insights into where and how you should be shaping your investment decision making today with a view of what capital growth is going to happen into the future. Now, Paul, let's give this report some bona fides, because there's a lot of reports out there that tell you all the reasons why you should be investing in a particular suburb. I think every man and his dog now has got a report.
Yep.
So the uniqueness of this particular report is Smart Property Investment puts this together without bias or agenda or fear or favour. So the absolute independence of Smart Property Investment means that we can actually go out into the marketplace and speak to all the experts that we need to speak to across the spectrum to get their insights on where you should be investing today for the best capital growth in the year ahead. We turn to Pure Property Investment as our principal partner as part of this, but we have a huge cohort of people, highly invested professionals who work in property every single day to give us their sense of it. Now, we'll go into that in a moment, who those people are and how we actually put the report together. But what I would say, Paul, is that we get it pretty right. If you look at the score sheet, this is the third iteration of this report. So, in about 6 months' time, we'll reflect and see how well we've done on this. But if we look back into the 2025 report, so when we recorded that last year, where to put your money for the best capital growth in 2025, I think we've landed 9 out of the 10 fastest growing suburbs in Australia were in that report.
Correct.
So looking back in hindsight, we chose 9 out of the 10. Fast forward to where we are, that's where they are. That's not bad going. That's a 90% sort of rate, and I think the one missed it is just slightly out of it.
Yeah,
right?
it's not out of the 50.
No, that's not. That's not 9 out of the 50 have made it. This is 9 out of the
11,000 suburbs.
Okay.
Yeah, but it's no easy feat to actually say, essentially data backing via CoreLogic data, via 2025 growth data over the previous 12 months, rolling 12 months, that 9 out of the 10 suburbs that we pecked were in that report. Now, the growth is significant. Now, not to suggest that you're going to get that growth every year on year, and there's disclaimers left, right, and centre. But
what is it? What is it? Indications today don't indicate
current returns, future don't.
Yeah.
But when it comes down to it, we're talking like in the vicinity of 25 to 40% growth in some of these suburbs over the past 12 months.
Yeah.
It is extremely significant.
Okay, and I think the score sheet for the 2023 report, which was where to put your money for 2024 growth, was consistent with that.
It was very consistent. I think it might have been 4 out of the top 10 in that year as well. We're in the 4 fastest growing suburbs in Australia out of, again, close to 11,000 suburbs.
And largely
the year before.
the 50 outperformed. The 50 that were identified
outperformed hands down. And the average was more than double the national average in both of those years. And I think that the important part of this is also, and we'll talk about this a lot more, I think, as we unpack this, is how to use this report and also considering, are you investing for 12 months? Are you investing for 5 years, 10 years and beyond? but we'll break down the fact that it's not just about growth in this report. We also break down what is the correlating yields, what's the cash flow, because ultimately some investors just can't afford to invest for growth if it's going to be sacrificing a whole bunch of cash flow, and vice versa, which we will unpack in great detail shortly.
Yeah, we absolutely will. And it gives some sense for everyone. And you know, this is a bit of an introduction, give you a sense for what we're doing. We're going to break down the states which had the largest cohort of suburbs. Western Australia, Queensland. It's very consistent with previous reports, but another huge major entrant, as you would expect, into this for suburbs and locations in Victoria. So we're going to get into that. So that's 3 specific podcasts we're going to do on those areas, which is great. We'll break down each of the different suburbs and give some sense to why they're moving in the way they are. We're going to look at the rest. There's a couple in Canberra, a couple in New South Wales,
Some in Tas.
there's some in Tas. So there's good sprinkling, a couple in some of the other locations. So we're going to get stuck into that as well. And then what we're going to do for the final installment of this is look at metro and regional, and 36% of all of these suburbs were in metropolitan. Australia. Well, sorry, regional Australia. The remainder obviously was in metropolitan, but it gives some sense. The cheapest regionally priced location, as in median value, was 398K, so sub 400K. So you can get into the market in these areas that we've identified for sub 400K. Now let's talk about that very quickly. If you're a new investor, you're borrowing at 90% with all your other costs, legals, stamps and stuff. How much do you need to get into that?
55, 60.
Okay.
Yep.
Which, you know, it's still a fair chunk of money, but
it is,
you know,
but it should be
you're
attainable
focused,
for
it's
someone who's
attainable.
focused on if you're talking about what do I need to borrow, $400,000 from a bank standpoint, if you've got no other outstanding debts, you're probably talking, if you're on an income of circa $80,000 to $100,000 a year, whether it's individual, collective, and there's no dependents, no debts, that's probably going to be attainable if you can find yourself $50,000, $60,000, $70,000 in equity /cash /guarantor loan. That's your starting point.
And then the top end of the Fast 50 was $1.5 million.
Yep.
So it's a spread there of $1 million.
Yeah.
Largely.
Yep.
And that was obviously a metropolitan location in Brizzy. So gives you a sense. So that's how we're going to lay out the 6 podcasts we're going to do to give a lot of narrative and color around it. So enjoy it, and please keep your commentary coming along wherever you're tuning into this. You leave some comments if it's on YouTube. Leave any remarks you want, and we can give you more details over time. We're going to check back in a few months' time just to update, and we'll probably answer a lot of questions around it. We did that last year, and that was a really interesting and also valuable podcast for a whole bunch of people. We might even do some live stuff. You let us know what you want to do. But the question for you, Paul, is why has Pure Property got involved in this again?
Well, mate, I think it really is hand in glove with what we do and what we've done for a long time, which ultimately we're a research-based business that looks at data to then dictate where we should and shouldn't be buying. And when it comes down to it, being involved in this report with your team, and ultimately with the fact that it's a no bias, no agenda, we don't have a persuasion to say we want to recommend one market over another. There is no benefit and there is essentially no dissuasion for us to say we should or shouldn't be in those areas. And partnering with your team to be able to put together a report that gives not only our ability to put the insights on paper, but also then to collate it in a way which you've got a very big machine with a lot of data and a lot of actual manpower behind it to actually put a lot more robust aspects in there, which will give a lot more context to what we look at, means that we can produce a report which I think personally nowhere else in this country can actually do or has done or will do in the future. So when I look at it, if I want to put something out there and I want to put pen to paper on markets and context as to where and what people should be buying, it's been a no-brainer. And I think the feedback, both from the listeners and also from our clients, has been fantastic because it allows people to have some confidence, not only in what they and where they're buying, but probably a little bit more about what the aspects that they are looking at as to why they would be and wouldn't be considering certain areas as well. So for me, it's been a great tool, not only for people to get comfortable with what are the things that indicate leading markets, but also to give people confidence as to what are some of the things, if they're going to do it themselves, what are some of the things they should be considering to look at, to use, and to access before making a very, very big and important long-term decision.
And it's a huge decision, and this is where, outside of the superannuation contributions that your employer or you make yourself, you're self-employed, you super. This is where the rubber hits the road, where and how most people are going to manufacture
It's
wealth
number one.
for looking towards a retirement. And we record this particular podcast under the cloud of issues around whether or not superannuation, unrealised gains of superannuation is going to be taxed, etc. We typically have a window for this report. Like last year, we announced it a little bit earlier. I think it was around February or March.
Yep.
We typically we're like the Eddie in Waimea Bay. We have a window when we're going to release it. We try and do it at the front end of the year, and it was important for us to release this subsequent to the federal election because there was a lot of what ifs, and we saw how much property dominated the policy settings and decision makings as the parties took themselves into election to try and win government and or win seats. It was central to the Greens agenda. It was central to the coalition's agenda. It was central to the government/Labor's agenda, how they're going to use property to help shape the future for Australia. So we were patient. I wanted to get it out a little bit earlier. We just wanted to wait until the election took place. So Australia actually had an understanding of what the future looks like. And I think, to touch on it very briefly, we've got continuity of government, and continuity of government is a good thing, irrespective, I think, of your particular leaning. Australia needs a period of time of sustainable, sensible continuity, and I now think we have this. We re-elected a Prime Minister for the first time in 20 years since John Howard. So, Australia has voted, they've got to get down to business now. The honeymoon is over, time to start governing. And I think we're going to see at least, probably 2 terms of the current government.
It looks likely.
Considering what's happening in the background. That may change, but got a period of continuity, right? So we wanted to get all this behind us and then the rate announcement before we get on air and start talking about these things. So what you need to take from that is that it's steady as she goes. It's going to be business as usual with some stuff in the background around the implementation of some of these property-related tax stuff, government incentives for first-home buyers. It's all going to shape property market. It's going to give us plenty to talk about. But we now know what we've got.
We do. And
there's no excuse not to do anything now. I'm going to wait for interest rates to start coming down. I'm going to wait to know who's in government. I'm going to wait to see what they're going to do with this. I'm going to wait to see what they do that. We know what's going on now.
The irony is, Phil, and we've been property investors for a long period of time now, and it's a bit sad to think how long for, because it does show our age a little bit more now, because it was a lot more bright-eyed and bushy-tailed when I feel like we were first doing this stuff. But it's probably for the last time I can remember. I'm talking maybe. I struggle to find a time where I have more certainty as to what's going to happen over the next 3, 4, 5 years than I have in the previous 15. Like that, I don't see there hasn't been a window where I haven't seen the fallout of the GFC going into what was probably the last real consistent, real decent boom of the Australian property market was probably circa 2012 to 2016. What happened in 2016? We saw intervention by government then because markets boomed and we saw too much lending going out, and then there was that intervention by the APRA, ASIC handbrakes that were going on to lenders to stop that, and then it went to the Royal Commission into the banking sector, and then we had multiple different governments throughout that whole time. Then we had COVID, then we had another change of government, then we've had Trump, and now we're out of that. Well, we've still got Trump. That's probably finding its feet now, but we've got continuity of government. We've got probably a stable unemployment sector, and we're now into a position where we've gone through a huge rate increase environment, starting to be incrementally cut, and probably landing into a relatively soft balancing act, which I think will play out over the next 2 or 3, 4 years. So if we're looking for a time of stability, as much as there is always going to be instability around the world, from an Australian standpoint, it's probably the most utopic you'll find it, and you're never going to find a perfect moment.
Yeah, all those reasons why you haven't been investing have largely been eroded. Now, there's still some uncertainty, global uncertainty. You don't know what Trump's going to do, what's going to happen with tariffs, the geopolitical, geostrategic situation. There's always going to be headlines out there. You don't know what's going on, right? Even today, I saw the Reserve Bank governor coming out saying, hey, they're not ruling out the possibility of a recession, right?
Yeah, absolutely.
Yeah, they're saying it may happen. We don't think it will. However, if this and that happens,
the states is odds on for a recession all of a sudden now. Like that wasn't the case.
So you just don't know. So there's going to be stuff you can't control, but hopefully this particular report will give you some sense for it. Now, thanks to the team over at Pure Property for being involved. So yourself, you contributed to this. Aaron Findlay, one of your senior buyers agents, contributed to this. So it was great to see him involved as well. Lena Lindley, also senior buyers agent, Pure Property, contributed to the report. And both of those people have been on your podcast, the Pure Property podcast, giving us a sense to the work that they do. So you can go and tune into this. But what we've done here, and this is the basis of this report, is that rather than just a couple of people, one person saying, this is where the data's told us to do it. This essentially, and you think of it this way, is the Trivago of reports. So what we've done is that we've curated the views and opinions from a whole bunch of different people with the sole agenda of where should you put your money today for the best capital growth in 2025. And we've curated all of that together, and with a particular methodology, which I'll explain in a moment, we've gone out there and we've been able to determine exactly what these top Fast 50 suburbs are. So what we've done is that we've gone to someone like Paul or some of our other experts and said, you tell us the suburbs. You give us the 20 suburbs that you feel is going to give that objective, best capital growth in a year's time, without bias or agenda. So Paul might do it a particular way. Another buyer's agent or an economist might do it a different way. Everyone's got their own methodology for determining this. We've just said, give us the outcome. And then what we've done is compare and contrast all of them, look for commonalities in where those assessments are. And that's really just helped us shape out the report. So in simple terms, of the 12, 13, 14, 15, what's it? 1, 2, 3, 4, 5, 10. 14 experts. If every single one of those 14 experts said this suburb, obviously that's going to rank really high. If only one of them said this particular suburb, is going to rank lower. So what we've done is look for that shared consensus of opinion based on different methodologies, how these different experts assess it, to look at where the clues are for what's going to grow in the way in which we're talking about. Then what we've done with that is we've overlaid that with property data, with a particular sort of set of methodology to help us get to this report. But as well as a pure property team, Sanjeev Saar, he's director over Investors Dream, he's contributed. Sam Gordon, many of you will know, director of Australian Property Scout, contributed to this. Thank you, Sam. John McGrath, of many of you will know as well, CEO and executive director over at McGrath Estate Agents, been in the property game for probably 30 years. Joe Vadillo, Chief Director over at Advocate Property Services. Matthew Hughes, Managing Director at Capital Property Advisory. Terry Ryder, again, a very familiar name that a lot of people will be familiar with, Director of Hotspotting. Mossy Terry, Principal at Rising Returns. I actually contributed to this report this year.
It's the first time you put your face
I know.
and name to a report, Philip.
I just said every suburb where I've got property, right?
Of course you did. Of course you did.
where the mouths say, hey, Phil, mate, I'm telling you, Port Headland's the place to be. Get in there quick. Get in. Dr. Diaswati, I always butcher this, and I'm so sorry.
I'm glad
Dr.
you're on this side of the microphone.
Marty Smo, Chief Economist at PRD, Real Estate. She's been on the
Despite
podcast
been
quite
on
a lot.
podcast a lot, hasn't
Yeah,
she?
she's exceptional. Kane Jury, Lead Buyers Agent Director over Discover Buyers Agency. A lot of you may know Kane. Kane, he's ex-Army guy now. He's doing a lot of property work with people within defence services and defence services. And Matthew Tiller, who's Head of Research over LJ Hooker Group. So some big names there from large real estate areas, obviously economists and buyers agents. So we've got a pretty good blend there, right? And each of these people can do their own report. They've told us all this. It's the gold. Such a privileged position that we're in to be able to put this together, and we've come up with a Fast 50. So pretty good going, Paul.
Absolutely, mate. It's a great list, and it's a great cohort of experts. And again, I think the beauty of this, if anyone's looking at sort of why would these people lend these particular suburbs to this report and how do they make this report, and we'll go through this breakdown shortly, is that there was a huge amount of crossover. There was a circa 200 odd properties in the list, in the long form list, which has been culled down via a method of elimination, which had to have some crossovers as far as number of sales, number of actual properties that were going to be transacting in those areas. We looked at things like geographical constraints, the amount of turnover, and a range of other things, which actually meant that they had to refine down to then therefore make the actual Fast 50 itself.
Yeah, and the in terms of methodology, you can go and read about this. If you're super technical, you can get stuck into it. But in a very simple way, sort of as an extension to what I mentioned before, it's largely we look for the commonalities of people's recommendations, and where more people recommended a particular location, obviously that had greater weight. That carried the bulk of the assessment. However, because you get some people sort of saying similar things, and you start breaking down the data, you've got to give a sense to the minutiae of it all. So there we applied data against it. So you might have 4 or 5 of these locations, which the same, like 4 people or 5 people said, yes, this is a great spot. then you got to break it down and actually, how do you compare them with each other? So we applied data overlays, numbers sold, median price, median quarterly growth, 12-month growth, 3-year growth, 5-year growth, average annual growth. We looked at median advertised rent to give a yield sort of point of view, and sort of gross rental returns. So we applied all those metrics. Look, go and look at the report. If you're sort of data buff and you can get stuck into it. But it worked out pretty well. Now, Paul, the big question is, how do you use a report like this?
Well, that is the big question. And for me, that's the part which it's not saying immediately go to the report and buy a property that sits within the report. That's certainly not what you should do, which sounds probably a little bit counterintuitive to most. But I think the first thing you need to do is try to understand what your position is and what you should be considering. Because as you've alluded to at the start of this first podcast, Phil, is that there is markets in this report, for example, that are in the 300,000s. There's markets that are in the $1.5 million, and there is markets everywhere in between. There is a split of regional and metro markets. There is some higher yielding markets, lower yielding markets, and there is also a big geographical spread as well. All these things mean that you should be strategic in what you should be buying, where you should be buying it, and that has to be specific to your circumstances. So our role to implement this report is to understand that first, to then suggest where and what we should be doing next. So for me, the report is super important for you to have a look at it, because it will give you some context as to where a vast array of experts think are going to see a well above average growth over the next 12 months. But for me, you want to apply some strategy before implementing the actual tactic of buying a property. So I would suggest, if anyone, first and foremost, download the report, smartpropertyinvestment.com. Go to the website to download the report first and foremost. You will get an ebook into your inbox, which covers everything that we're going to cover off in the next 6 episodes. But further to that, my team at purepropertyinvestment.com are able to then decipher your position, apply that strategy, and then overlay that with which areas, property types would likely make sense. And that's where our job comes into fold, is not just providing the suburbs, but giving some context as to where and what we should be doing. So purepropertyinvestment.com, after you've downloaded this report and had a good chance to go through it, is what I would suggest.
Yeah, and sort of further recommendation, do that now before you listen to any other of the podcast. It's going to give you, at least you've done your homework, you've got a sense for where it is. You can start applying the narrative to it. We're giving you the facts, but you've got to match that with the actual attributes of these locations, how that will sort of shape your decision making. Now, one of the reasons why we have the particular methodology that we use is that, it's not feasible or appropriate for us to say the number one suburb in Australia to invest is X, because that X might be below your buying budget, might be above your buying budget. So we need to make sure, and the way that we craft this report is that we get a spread which shows a sense of economy for all investors if they're looking to enter the market. We spoke about, our entry level is sub 400, our top line is 1.5. So there should be a solid location here to suit most people's budget, and that's absolutely critical. So go and download the report, smartpropertyinvestment.com.au. Do your homework before you tune into anything else, and I think you'll get a lot more out of the next sort of 5 episodes that we have here. Paul, I think we've sort of covered the key points there.
Absolutely.
Let's kick it off. You're probably frustrated going, just tell us where they are. Well, you're going to have to go and download a report, afraid. But that's the way these things work out. Go and do that. Go and download it. You'll enjoy it. I've got my copy here. It looks pretty fancy. It's a bit of a brick. It's there's no shortage of stuff here. Every single page has a
Times must be good, Phil. That is in full colour.
It is full colour.
Glossy too.
It is.
Good paper, full colour.
I obviously got someone to print it for me. That I'm a black and white sort of guy, and it's even single-sided.
Oh, geez,
Times
Louise.
good. Times are good. Times are good. Yeah, it's the property investment portfolio keeps delivering. Paul, thanks for tuning in.
Thanks, Phil.
We'll see you all again very, very soon as we break down the Fast 50 for 2026. We'll be back in a moment. Until then, bye-bye.